Will we get the kitchen sink this earnings season in the guidance? Mike Wilson at Morgan Stanley says this: markets often need the engraved invitation from a higher power to tell them what's going on. For bond markets, it's the Fed, and for stocks, it's company management teams. Mike Wilson, I'm pleased to say, joined us right now. Hey, Mike, do we get the kitchen sink then from management teams this earnings season?
Well, look, this is the question we don't know the answer to, right? We think we know the answer to where earnings are going. We've done a lot of work on that. That's where we have the highest conviction. I think that's where we're most out of consensus, is that 2023 will disappoint. But of course, for markets, the path in which you get there is always the question. And we think that there's plenty of evidence from a top-down perspective to do our analysis to say, hey, why don't we just cut the numbers? But as we said in this week's note, somewhat jokingly, but this is the way it works. The numbers are sticky until companies throw in the towel. People say, well, what's the consensus, earnings for next year? Basically, what they're saying is, well, what is the company management team guidance for next year? And they haven't really given us guidance, so that's why the numbers are always stale until they're forced to make those cuts. And so this is a time of year where companies can decide to kitchen sink it, as I said in the note, where they just throw in the towel, they cut costs and they lower the bar, or they wait until January when they have to give formal guidance for the full year for next year. So it's between here and there. I guess you'll get some of it now. I mean, we're seeing at the individual stock level, we're already seeing that, as Kaylee was saying, we're seeing some pretty bad earnings already from those who have reported, and they've thrown in the towel. So it's going to be a mixed bag. Our confidence on where we're going is high. Our confidence on the path is low.
Mike, just going over that line again, for bond markets, it's the Fed, and for stocks, it's company management teams. Does that imply that you and the team believe there is a part of this market that is further along in the adjustment process?
Absolutely, and particularly for bonds, right? So I would say a year ago, the most mispriced market was the bond market, and that's why stocks overshot to the upside, because rates were artificially too low. And we find it somewhat amusing, fixed income investors in particular are the most critical of the Fed, at least that's what we hear, yet they hang on every word. So which is it? Do you don't think they're credible, or you think they're so credible that you have to trade off of their every word? So it's really this weird dynamic. And I would say that bond markets have been chasing the Fed all year. The Fed has done their job. They've aggressively pivoted to a very hawkish regime, even more hawkish than we expected at the end of last year. And we were probably one of the more negative folks on the bond market. So I think the bond market's probably there. But unfortunately, kind of like stocks, the bond market needs to be told by the Fed that they're done, right? And that's just the dance we're in right now. It's the hardest part of the cycle to trade. We think we know where we're going in equities. We think yields are probably close to topping, but we got to go through the earnings revision still, which is why you can't say that stocks have bottomed.
Let's talk about margins then. One thing the bond market has been pricing over the last several months is the prospect of inflation rolling over in our future. Now, I think what matters to margins, and Mike, you've written about this a million times, is the pocket of the inflation story that sticks and the pocket of it that fades. When you think about what's going to fade here, Mike, from an inflation perspective, and what's going to stick, what does it mean for margins?
Yeah, that's exactly right. So we wrote a pretty detailed note this week, in addition to our weekly, around inventory, where we worked collectively with our analyst teams. And I mean, look, this has been a story that we've been talking about for 9 months. We said, look, that it's likely that the bottlenecks, get relieved, and then we'll see too much inventory. And I think where that's most evident is in, some of the apparel stocks, the retailers, where consumer goods kind of across the board. And it's likely that we're going to see outright deflation in a lot of those products as companies have to discount to move the extra product. I think areas where it's going to be tougher to get negative prices is going to be in say housing and rents, at least on a year-over-year, on a sequential basis, but maybe on a year-over-year basis we can get them to flat. And then of course labor. Labor now does have the upper hand a bit because of the pandemic, and I think we've moved into a different regime here. Where we're seeing a shift from capital to labor, so I don't think you're going to see labor costs come down. You may see them flatten out, but that could be one of the more defining features of this cycle, John, that actually makes margins worse. And what I mean by that is, U.S.-based companies are very good at cutting costs when they need to, and particularly labor costs. And because of the pandemic and the shortage of labor that may be here for a while, companies may not be in a position to do that as aggressively as they have historically. And if that's the case, then we probably see more margin degradation than even what we're modeling. And I'll just leave you with this. I think that the area of the market that a lot of clients are perhaps underestimating is negative operating leverage. Inflation increases operating leverage. However, operating leverage can cut both ways. It was positive in the lockdown during the pandemic, and now it's in a negative cycle. And we think that's where even we could be underestimating the downside to margin pressure because of that negative operating leverage story, and labor is part of that.
Mike, that is a very different market regime than what we've experienced recently and in years before as well. What does that mean for leadership within the equity market, Mike? Where does it come from?
Yeah, well, it's more the same of what we've been saying all year, John, and you know this well, which is we're very focused on companies that have what we call operational efficiency. They have their hands on cost. Working capital is not eating up their cash flows. Another feature what we're seeing right now. They're very good at running their businesses, and that's an idiosyncratic feature. It's not a sector feature per se. Now, some sectors can defend their margin position or operational efficiency better. Those tend to be the more defensive areas, where like healthcare is an example. Some of the managed care businesses look quite good in that regard. That's why they've traded well. I would say clearly some of the staples and beverages, but that's where we are. And then, of course, when we get to the trough, you're going to want to flip it exactly the other direction, because we're not in the camp. I think you were saying a minute ago, we're going to have like negative returns or flat returns for the next 5 years. That could be true point to point, particularly on a real basis after inflation. But there's going to be tremendous trading opportunities on the upside, just like there was in 20 and 21. However, we're still in the down cycle right now. So the way we're thinking about the next 5 years, John, which is probably different than most, is we're in this boom bust period. And we're in a bust period right now. We'll get through it, and then there's going to be another boom. So, as soon as you get your head around on the bust, it's probably time to start thinking about the upside. And that could be within the next 3 to 5 months.
Well, Mike, this is the perfect time to have this conversation then, because right now on my screen, we're making new lows for the year. The new low for the year, 35.82 on the S&P 500. Are you saying in the next few months, Mike, you could change course? And I think we should build on that a little bit more, because the risk, as always, as you know, is to become married to a worldview. Super bearish, become married to the position. You can't make the turn to come back into the market. Mike, I know that you haven't done that over the last couple of years. You were super bullish out of the pandemic, and then you turned. What's going to make you turn, Mike? What's going to make you that little bit more bullish to have that rip that you're looking for?
Well, the same thing we did in 2020 or that we did in 2017, when we found ourselves out of consensus. It's, you really are sold out. We could argue we are now. But then our fundamental metrics are telling us that we're at a rate of change low. So we're pretty disciplined around that. We don't get everything right. But, one thing we tend to be early. We're usually not late. Of course, right now, being early can be quite painful. I don't want to get too bullish here, because people then will construe my words to say, hey, here it's time to go, and that's not what we're saying. We're saying there's still, the last couple of innings of this bear market could be quite painful, okay? But you got to be ready for when that price gets to an attractive level. If it was 5% away, John, I would say fine. But we still think, kind of low 3,000s, even 3,000 is really where we're probably going. And so, as we go through 3,400, 3,300, kind of towards the low 3,000s, we've heard other people kind of throw those numbers out too, kind of nonchalantly. It's like, that's a big move, so you don't want to be too early in sort of getting your head around on that. But the things we're looking for the most is rate of change on earnings growth and revisions. Valuation could be the other way we get there, which is how we got there during the pandemic. Equity risk premium really blows out. And then, of course, we'll start to see, the whites of the eyes in terms of, say, economic growth, which will actually cause the Fed to pivot. They're not there yet. Okay, so those are 3 things that we're very focused on, and it's just the cake is just not baked yet.